Special journals and subsidiary ledgers. To segregate duties and to create efficiencies of labor, the general journal and the general ledger are often divided into special journals and subsidiary ledgers. First, we will look at the subsidiary ledgers and then the special journals. The accounts receivable subsidiary ledger. Accounts receivable represents amounts owed to the company by its customer. The company must know what each customer owes in order to bill and manage the accounts. Therefore, these records must be kept up to date daily. The individual records of amounts owed are kept by customer, the total of which is recorded in the general ledger in total. The general ledger account for accounts receivable is referred to as its controlling account. So here we have the accounts receivable subsidiary ledger, used for preparing bills sent to customer, and there's one account for each customer, and we can see what each individual customer owes, the total of which goes into the general ledger into the accounts receivable controlling account. Therefore, the controlling account balance equals the sum of all the subsidiary account balances. We have the same dynamic with the accounts payable subsidiary ledger. Accounts payable represents the amounts owed by the company to its vendors. The company must know what it owes each vendor to manage cash flows and to negotiate with the vendors. Therefore, these records must be kept up to date daily. The individual records of amounts owed are kept by vendor, the total of which is recorded in the general ledger in total. The general ledger account for accounts payable is referred to as controlling account, same dynamic as the accounts receivable subsidiary ledger. Then we have the inventory subsidiary ledger. Inventory represents the goods the company has for sale. The company must know at all times what types of goods are available for sale and the total number of items on hand. This information is used to aid in ordering and managing inventory. These records must be kept up to daily as items are sold and purchased. Individual inventory accounts are kept by type, the total of which is recorded in the general ledger in total. The general ledger account for inventory is referred to as its controlling account. So now let's look at special journals. Special journals, which are arranged in columns, are used instead of the general journal to record all sales on credit. Those go into the sales journal. All cash receipts and cash sales, that's the cash receipts journal. All purchases on credit, this is the purchases journal. And all cash payment, the cash disbursements journal. So we see we have two journals that are revolve around credit, all sales on credit, the sales journal, and another, all purchases on credit, the purchases journal. Anything not done on credit goes into the cash receipts and cash sales journal, the cash receipts journal. Any cash payments goes in the cash disbursements journal. Now, what do we use the general ledger for then? Well, we use it for any entry that does not fit into these categories, including all of your adjusting and closing entries. The trick will be to change the way you think about journal entries from items that are entered line by line to items that are entered by columns. So let's see what these look like. Let's first of all look at the sales journal. These are all sales on credit. Prior to this, you would have entered accounts receivable for Jason Henry, $450, record the sale for $450, record the attendant cost of goods sold for $315, and the inventory that is no longer there because it's been sold in the amount of $315. Now these entries will go into columns. Now of all the special journals that we'll look at, the sales journal is the easiest to follow. See the February 2nd entry. February 2nd, Jason Henry. This is the invoice number. This is the amount for the accounts receivable. This is the amount for sales. The debit and credit entries are combined in this column. The cost of goods sold, debit, and the inventory credit, these amounts are combined in this column. Daily, the company will update the subsidiary ledger for each customer but transfer the total of all accounts receivable to the general ledger at the end of the month. So daily, they will be updating the accounts receivable for the customers but record the total at month end. The same was true for the sales. That will be recorded at month end. The column for accounts receivable is combined with the column for sales because the amounts are the same. The column for cost of goods sold is combined with inventory. So now we see, instead of looking at things line by line, we have to think about them more in this kind of dimension of putting them in columns. All the column totals will be transferred to the general ledger at the end of the month. The number in parentheses at the bottom of the columns represent the general ledger accounts number for accounts receivable, the controlling account, sales, cost of goods sold, and inventory. The PR column or the posting column receives a check mark when the amount charged by the customer has been recorded in the individual customer's account. You won't see this in Connect, but you will see it in the Per Disco project. Transferring the journal entries from the sales journal to the subsidiary ledger and the general ledger. So here we have all of the individual accounts for our customers and the individual amounts. And then we can see for each individual customer, they have been updated for each individual sale. Now let's look at transferring this information to the general ledger. We can see that accounts receivable, the controlling account receives a total. The sales receives the total as a credit, and the cost of goods sold and inventory receive their respective debits and credits for $1,500, and we can see that these are the account numbers associated with these columns. Let's look at the cash receipts journal. The cash receipts journal is much more complex than the sales journal because it records more than one type of transaction. It would include cash receipts from loans, cash sales, cash receipts on customers' accounts receipts payments, interest income from bank statements, and any other cash receipt of cash. So we can see we have many more types of dedicated columns. All of them will be a debit to cash. This is cash receipts. And then we have debits here for sales discounts. When we purchase, we make a sale, and the cash sales discounts associated with that. Then we have accounts receivable credits, the sales credit, other accounts that are credited, and cost of goods sold and inventory for cash sales when they're debited and credited. So let me go through this individually. So here we have a cash sale. So the sale is for $4,450. Cost of goods sold $3,150. So we can see that this would go into our cash debit column. This would go into the credit for the sales column, and cost of goods sold and inventory will be combined together. These are the account totals. The account numbers in parentheses underneath here. Sales. So cash sales. The journal entry is recorded in the cash and sales columns with the sales price and combined in the cost of goods sold and inventory columns based on the inventory value. So we're looking at this cash sale on February 7th. These amounts are recorded in the general ledger at the end of the month. So every one of these was recorded at the end of the month. There's no subsidiary ledger involved except for the inventory, but your book doesn't show the inventory being updated daily. You will see that in Per Disco. You won't see it in your book. These amounts are recorded in the general ledger at the end of the month, and an X is placed in the PR column since they are posted simultaneously. The number in parentheses at the end of the column represents general ledger account numbers. Next, we have a cash receipt on a customer's receivable. See the journal entry of February 12th. So here we have a customer, we have a receipt of cash on a customer who's paying on their account. They pay within the discount period, so they're going to take advantage of the sales discount. So here we can see the debit to cash, we can see the debit to the sales discount, and we can see the credit to accounts receivable because they've paid off their balance. These for accounts receivable will be updated in the subsidiary ledger for each one of these customers. Cash receipts on a customer's receivable. See the journal entry of February 12th. Is recorded in the cash discount, if any is taken, and the accounts receivable columns. The customer's accounts receivable balance is updated as the journal entry occurs. The total amounts in cash discounts, and the total accounts receivable or controlling account are posted to the general ledger at month end. The PR column is checked when the customer's subsidiary accounts receivable is updated. Next, we are going to have the receipt of cash attendant to a notes payable, and then also the receipt of cash attendant to interest revenue. These are transactions on February 20th and 22nd. These will be in other accounts. These are other cash receipts. The transaction is described, see February 20th as notes payable, and February 22nd as interest revenue. The PR column will have an account number for the credit side of the cash transaction. So here we have notes payable, and we see the PR column here has the account number for notes payable, and then this is the account number for interest revenue. The amount is placed in other accounts column and posted to the general ledger as the transactions occur. So other accounts get updated daily, as well as all the subsidiary ledgers. Since they are posted as they occur and the cash updated at month end, the bottom of the column for other accounts will have an X instead of an account number. Here we see them being transferred. So it's a little hard to read, but this is the accounts receivable ledger. So as customers pay, we see the credit associated with their payment. And then at month end, we see the transfer of the total columns to cash to the dedicated columns as well as the other accounts. So here we see accounts receivable updated at the end of the month, inventory updated at the end of the month. However, this is just the book example. In the Prodisco example, you will be updating inventory as you purchase it and as you sell it. Notes payable at the end of the month, interest revenue at the end of the month, sales at the end of the month, and sales discount at the end of the month. I'm sorry, let me go back to that. Forgive me. Notes payable, it's on February 20th, not the end of the month. So it's in other accounts, so it's updated daily. So forgive me for saying that. Again, the same thing for interest revenue. It comes from other accounts, so it will be dated February 22nd. The rest of these totals will be dated February 28th because it's at the end of the month. Sorry, I misspoke. Now let's look at the purchases journal. This records all items purchased on credit. The purchased items are generally inventory and office supplies, as well as other types of purchases such as store supplies. So here we have a simple journal, but we have a little bit more of a complicated transaction. In this instance, in the first one, we're purchasing from this vendor, but we are purchasing inventory as well as office supplies. The rest of these are just purchases of inventory, but at the bottom we have one where we're purchasing store supplies. So we're going to describe it, we're going to put the name of the company, the date of the invoice, the terms, etc. But this 125 will represent the account associated with the other accounts, which we'll find which was store supplies. And so we can see that from this vendor we purchased inventory, office supplies, and then store supplies. So that's placed in individual columns. So a purchase of inventory and also a purchase of supplies. We see this is the transaction of February 3rd. So purchase of inventory. The vendor accounts payable subledger and the inventory subledgers would be updated as the transaction occurs. See the February 3rd journal entry. The total posted would be posted at month end. The PR reference checked updated as AP and inventory subledger. The post reference is checked is updated as accounts payable and inventory subledgers are updated. So you would check this off as you update those. Sorry, that kind of reads funny. At the end of the month, the totals are transferred to the controlling accounts, and the columns have the account number for AP and inventory in parentheses. The dedicated column for office supplies would be updated at month end. The account number for office supplies is at the parentheses at the bottom of the column. So these amounts would be updated as they occur, this one at the end of the month. Purchases of office supplies. See the February 3rd transaction. In case your book just has purchases of, or your project has just purchases of office supplies. These transactions recur regularly and are therefore have a dedicated column. The posting reference is checked when the vendor accounts payable subsidiary ledgers are updated as the transactions occur. At the end of the month, the total is transferred to the AP controlling account. Additionally, the office supply account is updated at month end. The columns have account numbers for AP and office supplies in parentheses. So I just sort of repeated that first journal entry that we looked at on February 3rd, just in case you had one that was just a purchase of office supplies. Now here we have the one that's a little bit more complicated, and this is the one on the 28th when we're purchasing store supplies. So other accounts, usually store supplies, etc. The individual vendor accounts and the other general ledger accounts are updated as they occur. So again, individual vendor accounts, customer accounts, and inventory accounts are updated as they occur. Anything in other accounts is updated as it occurs. Everything else goes in at the end of the month. Office supplies total will be transferred at month end along with the totals for the controlling accounts payable account. The PR column has both the check for updating the accounts payable subsidiary ledger as well as the other general ledger account number associated with the transaction. So here we see that. Since other accounts are updated as they occur, an X is placed at the end of the column. Office supplies has its own account number in parentheses. Again, you won't have these checks and these numbers in parentheses in your Connect project, but you will have it in Prodisco. Now here we see the transfer to the accounts payable ledger for all of these individual transactions as we charge. And then here inventory again would be updated daily. The office supply total goes in at the end of the month of February 28th. And then the other accounts would happen daily. It just so happens that this one also happens to be at the end of the month. So it's also on February 28th. But if it had been on the 27th, it would have been done daily since in other accounts. And then accounts payable, the controlling account, the total would be transferred as a credit to the general ledger account. Let's look at the cash disbursements journal. Last of our journals records all cash disbursements for inventory purchases, salaries, expense, and payment to vendors for accounts payable. I think the salary expense should have a dedicated column, but in this example it doesn't. So here we can see the account to be debited, the posting reference, the cash is being credited because we're dispersing cash. I'll talk to you about the inventory credits as we go through it. It'll be easier for me to show you than to just talk about it here. Here we have other accounts. Again, those would be updated daily, and the accounts payable debits, those would be updated to the individual vendors, and then the controlling total transferred at month end. So payments to vendor. So here we have on February 15th the payment to a vendor. Accounts payable is being debited for $200. We're paying cash of $196, and we're going to take an inventory credit for $4 because we're paying within the cash discount period. So this is a payment to a vendor. The company pays within the cash discount period. So this is the February 15th journal entry. Cash updated at month end. Inventory and individual vendor accounts are updated as the transactions occur. And we credit inventory so that inventory will be reflected at the amount that we paid for inventory. See or review the transactions associated with cash inventory account. Credits to inventory when we pay within a cash discount period. You would find that in retail transactions. I believe I have a YouTube video up in that. Sorry, I just kind of blanked out there for a moment. All right, salary expense. Now we're paying salaries. Salary expense doesn't have a dedicated column, but it's recorded in other columns. Any amount recorded in other accounts is updated in the account as the transaction occurs. The account number for salary expense is in the PR column. Since these accounts are updated continuously, there is no account number on the column, but an X is placed there. The cash account will be column will be updated at month end. So here we're paying salaries. We describe it as salary expense. This has the salary expense a general ledger account number, crediting cash, debiting salary expense. It's under salary expense, which is updated daily as these transactions occur, and so it'll receive an X. Now, what about these crazy things here for accounts receivable debits? These are, other accounts debits. These are debits to inventory. Other accounts, see February 3rd and February 12th transactions. Your book illustrates these transactions, which are debits to inventory when inventory is purchased with cash, but neither projects contain these transactions, so I'm not going to belabor this long video with any more talking.